Have you ever watched tax advice videos on TikTok? If so, then you might have come across some videos making tax claims that just sound a little bit too good to be true. While some of those tax videos on TikTok are accurate and provide some sound advice, unfortunately, many of those videos provide advice that's outdated, advice that is misleading, or outright wrong. So in today's video, I'm gonna debunk some of those TikTok tax videos that I've come across. I'm gonna make sure that you guys watch until the end so you know the truth about the TikTok tax advice that I would like for you to know, and I'm gonna show you how to implement these strategies strategically inside of your tax returns. Let's dive in. All right, guys, this is the first video that I've come across, so let's watch it.
If you start an S corporation and you own 100% of your S corporation, that you can buy everything that you own under that S corporation, and then you don't pay taxes on anything that you purchase because it's considered a corporate expense. And you can take one corporate vacation a year, and depending on how much money your corporation makes, that price actually fluctuates up. And you can actually hire your children to work for you for $12,000 a year tax-free. So then you're actually showing an expense, but you're gifting it back to your own family household. And then you pay yourself a salary, which means you pay less self-employment taxes. And then basically at the end of every month, you're left with $0 to pay real taxes on. It feels really shitty to do it, but it's kind of how you avoid paying taxes. So I don't know.
All right. Okay, guys, there's a lot to unpack in this video. First of all, she's claiming that just by having an S-corp, you can suddenly deduct every expense that you make in your life, including your vacations, as business expenses under your S corporation. This is 100% not true. And in fact, trying to do so could get you into a lot of trouble with the government. Even if you have an S corporation, you are still only allowed to deduct just business expenses. You cannot just deduct anything that you want to. For example, if you buy a new swimming pool for your primary residence, or if you take your family on a vacation to Aruba, you cannot just deduct these expenses. Why? Because they're not business expenses. So in other words, your pool or the trip to Aruba needs to be able to help your business run in some type of way in order for it to be a necessary expense in order for you to write it off on your tax returns. The IRS defines a business expense as the cost of carrying a trade or business. And in order to deduct a business expense, the expense must be ordinary and necessary. So for an expense to qualify as a business expense, it must be directly related to the running of your business. When the IRS says that the expenses must be ordinary and necessary, this means that the expenses cannot be overly extravagant. For example, if you decide to buy solid gold bars for your employees to use as paperweights, you would have trouble getting this approved as a business expense because it's unnecessarily extravagant and definitely not ordinary and definitely not necessary as a business owner. Just to reiterate, owning an S corporation does not mean you can deduct any expense in your life. However, the second part of what she said about hiring your children in your business has some truth to it. If your children are under the age of 18, then you can have them work for your business and they can earn up to $12,950 without having to pay taxes on that income. Also, you won't have to worry about paying payroll taxes on the money you pay your children if your business is an LLC or a sole proprietorship, but you will still be able to deduct the money you pay your children as a business expense if you have an S corporation. So these are just some things that I wanted to point out. All right, guys, if you're going to hire your children to work for your business, you must comply with all the conditions of the Fair Labor Standards Act, which does things like set limits for the amount of hours an adolescent can work per day, the types of jobs they can work, and it also sets the minimum employment age to 14 years old in some cases in some states. If you have any questions about how to strategically place your children on payroll without causing additional tax, then definitely make sure you click on my Children on Payroll guide below. I have a whole guide that'll teach you how to place your children on payroll. Now let's jump into the second video that we want to debunk.
G-Wagons weigh more than 6,000 pounds. Those 6,000 pounds qualify the car for Section 179, a rule in the IRS tax code that allows business owners to write off the car as an expense. Normally you would write off the car over 5 years, but cars that are under Section 179, you're able to deduct the entire amount in the first year that you purchase it. To do this, you're going to need a business like an LLC or an S-corp, and you also have to use the car for more than 50% of the time for business purposes. You can take the deduction even if you finance the car. So you could put a $20,000 down payment, finance the remaining $150,000, yet still claim $170K in tax deduction. So if your business made $200,000 in net income and you took the full deduction, you would be taxed as if you only made $30,000.
All right, guys. So in this video, This guy is a great friend of mine. His name is Humphrey, but he is saying that you can buy a vehicle such as a G-Wagon that weighs over 6,000 pounds and that you can claim that you use it at least 50% of the time for your business and then write off 100% of the purchase price. He says that section 179 of the tax code allows you to do this, but he doesn't have this completely right. So I'm going to come over the top and make sure that I can spruce up the explanation. The first thing that you need to know is that if you're trying to claim a deduction for the business use of your vehicle, you really must actually use your vehicle for business. You cannot just buy a G-Wagon and claim that you use it for business 50% of the time if you really aren't. Additionally, you must document your business mileage and your personal mileage. The IRS requires both. They literally say you have to do personal mileage and business mileage to determine how much of your car is actually being used in business. The next thing that I want you to know about this whole code section 179 thing is that the amount that you are able to deduct from the vehicle purchase price depends on what type of heavy vehicle it is. So yes, for some vehicles, you can deduct 100% of the purchase price. However, for other vehicles, they have deduction limits of $18,000 and $25,000. So you will need to look up the bonus depreciation deduction limits for the specific vehicle you're thinking about buying before you buy it to know how much you'll be able to deduct with code section 179. Oh, those are two strategies, code section 179 plus bonus depreciation. Hence, that's why we're talking about this right now. Also be aware that deductions do not apply to any heavy vehicles. So for example, there is a maximum weight limit for SUVs, which is 14,000 pounds. So if you're buying like big SUVs that weigh over 14,000 pounds, we can't write all of those off in the first year. Furthermore, you need to know that according to code section 179, the amount that you're able to deduct from the vehicle's purchase price is proportional to the amount that you use for business purposes. Okay, this is super duper huge for me to explain. I have a lot of taxpayers who go and buy business vehicles at the end of the year thinking that they're going to be able to write off 100% of the purchase price. But then when it comes to the tax return, we find out that the vehicle's only used 60% business use and 40% personal use. So even though you put a down payment down and you financed a vehicle, you may not be able to write off 100% of that purchase price because you're only using 60% of the car for business. So if you spend $100,000 on a G-Wagon or a Ford Explorer, whatever it might be, I'm not going to be able to write off $100,000 unless it's 100% in business use. If it is 60%, I'm able to write off the $60,000 on your tax return. Here's another thing that you need to be aware of with the code section 179. In order to qualify for the deduction, your business's name must appear on the title of the vehicle. So if you only have your personal name on the title of the vehicle, then you technically need to make sure you're doing some maneuvers in order to still deduct this vehicle on your tax return. And this is where working with a tax strategist helps, because a tax strategist can allocate a vehicle to your business in case a vehicle was not purchased underneath your business. And this becomes really helpful for taxpayers who are trying to figure that whole situation out. So basically, guys, the main thing to understand here is that unlike what Humphrey was saying in the video, you can't just buy a heavy vehicle and write off 100% of the purchase price. He did cover a lot in here. What he was missing was you can only write off to the extent of what's in business use. If you do purchase an SUV, a van, or a truck that's over 6,000 pounds, you use the vehicle for business use and it's at least 50% of the time, there's a good chance that you'll be able to write it off on your tax returns. Just keep in mind that you need to track your personal use versus your business use so we know the percentage that we can take as tax professionals on your tax return to actually get the benefit that we're looking for. And in some cases, you will be able to write off the whole thing. Finally, the last thing I want to say about writing off vehicles with code section 179 is that being able to write something off is not the same as being reimbursed, okay? It's not like the IRS is going to give you all your money back that you just spent on the vehicle. That's not how it works. It isn't. Instead, if you qualify for the bonus depreciation deduction in combination with section 179, then your overall taxable income will simply be reduced by the amount of the deduction you receive. Get what I'm saying? Okay, so hopefully this is making sense. Matter of fact, let me give you an example. Let's say that you have a taxable income of $200,000 and you buy a new truck for $50,000. That qualifies for 50% deduction since this will be used for business use and it'll be used for personal use. Let's just say personal use is 50%. Now, in this case, you will be able to deduct $25,000 from your overall taxable income, which would leave you with a taxable income of $175,000. The IRS will not write you a check for $25,000. It would just be deducted from your taxable income. Okay, I get a lot of people that are confused on that. So with this example, yes, you would be able to save some money on your taxes, but no, the government is not going to just give you $50,000. So don't expect the government to pay you to buy a new vehicle. Okay, Now let's move on to video number 3.
If you're mad about Trump not paying taxes, if you're mad about Trump lowering taxes for the rich and the companies, listen, do you want to have those benefits? I'll tell you how to get them. Open up an LLC, limited liability company. But John, I don't have a business. Open up a lawn business that cuts your own lawn every week. Doesn't matter. Run some revenue through it. Pay yourself $20 a week to cut your lawn. Pay it through your company.
Oh, this guy is suggesting that you can get tax savings by essentially opening up a fake company, being a client of that company, and then paying yourself as the client and then receiving the money as the business owner. This would be nice if it were true, but unfortunately, this advice really just makes no sense. And hopefully you guys can see that. Here's why. If you set up an LLC in which you pay yourself, the income you receive in this new LLC would be taxable. So you would essentially be taking non-taxable income from your bank account, then paying it to yourself for a fake goods or services rendered. But when you receive the income, you would have to pay taxes on it. So you can avoid this ridiculous situation altogether by simply just not setting up an LLC that does nothing, that only has you, yourself, and a client. It's very simple, guys. If you're thinking about trying to create a fake company, just don't do it. Start a real business that has real goals with a real business plan. Now, let's go over the second part of this video. This guy suggests some really interesting things that I want to cover.
You have a home office, right? You do your taxes in your kitchen. You file paperwork in your kitchen. That's your home office.
Now, for the second part of this video, guys, the guy suggests creating a home office in your kitchen for your fake business. There are two things wrong with this. First, you cannot have a home office for a fake business in which there are no real customers and no real business activities. So let's just check that list off. And in fact, this could be perceived as fraud. The second thing wrong with this is if you're going to have a home office has to actually be exclusively and regularly used for business. Obviously, if your home office is your kitchen counter table, this is not exclusively used for business. The IRS does not favor you and try to help you claim this deduction. And if you're taking it from your kitchen, where you spend time, cooking, flipping hamburgers, stocking your cabinets, eating cereal. This is being used for business sometimes and being used for personal sometimes, which makes it hard to say that it's exclusively used for business. So the IRS is not going to allow it. So you could potentially get into trouble with the IRS for trying to do this as well. If you actually had a legitimate business with legitimate customers, and if you had a space in your home that you actually use exclusively and regularly for business, then yes, of course, you could potentially qualify for the home office deduction. But guys, please definitely do not try to claim a home office deduction if you do not have a legitimate business and you're not legitimately working from home and using a legitimate part of your home exclusively for business use as an office space. Okay, now let's take a look at the last little piece of this video before we jump on to the next one.
You gotta have clothes to wear while you're mowing. That's your uniform.
Okay, now let's talk about the uniform bit. If you do not have a business, you do not have a business uniform, regardless if that's what you're trying to call the clothes you wear while you're at work, okay? AKA not working. And again, you will not actually save any money by trying to write off your uniform. This is because if you claim income for your business, you will have to pay taxes on it. This would negate any tax savings you might get by deducting closing costs for the uniform. Also, making fake deductions is a form of tax fraud. I just want to put that out there, and it should be avoided at all costs anyways. So if you're trying to do some of the things that this man is saying, essentially, if you don't like prison and large fines, then you should probably stay away from this advice and completely avoid it entirely. Now, he has a good intention. He's trying to tell you how to use the system. Unfortunately, when you pop off on TikTok, it can come out wrong. And when you're trying to help people, you need to make sure you're coming from the right place. Simply setting up an LLC and trying to write stuff off is not going to help you. It's going to put you into trouble with the IRS. Starting a business and having dreams and goals and wanting to see those through, that is something that I can get behind and something the IRS can get behind. As a matter of fact, you probably are going to work from home as you start that dream or vision and talk to customers and create your website. And that would allow for you to take a home office. And maybe you'll invest in getting yourself some branded logos and some branded shirts and some branded signage. That would be tax deductible for you because now it becomes ordinary and necessary for your business to do business. And that's how we get these write-offs that we're talking about. Let's jump into video number 4. There's some big stuff that we have to talk about.
I thought, can I write the boat off? Can I take clients out? So I bought a large boat. That boat had a kitchen and it
Okay, so he bought a boat.
had a bathroom in it and you could sleep on it.
The boat has a bathroom and it has a kitchen, so he's going somewhere with
Lo and
this.
behold, the IRS tax code says that if you have an RV, a motorhome, a boat, and you can sleep in it, eat and cook in it, and you can bathe and shower in it, lobby dog, you can call that a second home. It saved me $4,500 a year.
So Basically what this guy is saying is that if you buy a boat, camper, or an RV that you can bathe, sleep, and eat in, then you can write this off as a second home. Unfortunately, this is not entirely true. You cannot write off these types of homes in full. You can, however, write off the mortgage interest and the property taxes. And to be completely honest with you guys, if you already own a primary residence, you're not going to really get a whole lot of benefits from claiming a secondary home or an RV or a boat, because Donald Trump and the Trump administration slashed all of these deductions that you are normally used to taking, such as mortgage interest and property taxes. You can only claim $10,000 in property taxes in combination with your state taxes that you're paying into. So if you have property taxes in excess of 10 grand and you're paying into the state in excess of $10,000, you could see here how you're going to not be able to deduct all of this. Now you're going to throw in a secondary home. What's the benefit to you? It only benefits you if you're in probably a lower income threshold, and these homes are really going to be the biggest investments you're going to make all your life. So if you buy an RV, let's just say for $150,000, don't expect to be able to write off the full $150,000 or even the monthly mortgage payments. This is wishful thinking. One of the other things that you should know about this situation is that you're not allowed to claim the home office deduction for RVs, campers, and boats either. This is because the IRS views these spaces as too small to have enough room for an office that is used exclusively and regularly for business. If you find it peaceful to work in your RV or your boat, go ahead and do it. Just don't expect to save any money in taxes working out there. Now, if you have an office in your primary residence, you could potentially qualify for the home office deduction with that space. To qualify for the home office deduction, your home must be used regularly and exclusively for business, and it must be your primary place of business. If you have a separate structure on your property, such as a garage, a barn, an ADU, you could technically use a part of these structures as a home office as well. What I want you to understand about this particular situation is that there really aren't a ton of deductions that you can get just by owning an RV or a boat or using it as a secondary home. But if you could potentially rent out your RV or boat and use it in a business way, which is a different way in which you probably bought it, then this can lead to bigger tax deductions. And that's when I like to have fun and get creative on the tax returns. But if you were using your boat or your RV for a business, then you wouldn't be able to use it as much for a second home. So keep that in mind. Now, let's jump into video number 5. I've saved this one for last for a very particular reason. So let's take some time to review.
All right, KOT Forex, Hughesway. These brokers make sure you don't pay any taxes. Why? Because these brokers are not based in the United States. Therefore, every single dollar that you make is completely just for you and yourself. You don't gotta pay nothing. Enjoy your money.
Woo! Okay. What he is saying here is that if you want to trade stocks or other assets on an exchange or through a broker that is international and doesn't report to the IRS, that you won't have to report your income from your trades. Come on now. Here's the thing. Even if you make trades on a platform that doesn't report to the IRS and is located in another country, hidden under a rock, it doesn't matter, okay? The income to you is still going to be taxable. And by law, you are still required to report your income to the IRS, and the income that you report must be accurate, or else you're the one who signs off on your own return, not your CPA, not your tax accountant. You do. You cannot just leave out a section of your income because you earned it on an exchange in a different country. If you do this, you could evoke the wrath of the IRS. It might surprise you to hear this, but even if you earn your income illegally, you still have to report it to the IRS. This is actually how Al Capone actually got caught. He just didn't report his income. He was fine if he would have just reported his income. Now, I'm not to say that I'm getting behind Al Capone and all the things that he was doing, but this is how he got caught. He just didn't report his income. They proved that he had earned millions of dollars in income that he never reported, and they charged him with tax evasion. So even Al Capone can't get away with hiding earnings from the IRS. Then I don't think you should try it either. Definitely do not try to follow this as guy's advice, and try not to use foreign brokerage to hide your investments and trading earnings from the IRS. If you need to do those things, that's fine, but you're going to have to report it if you want to go to these foreign brokerages. So just be smart. This could come back to haunt you big time. Now, there really isn't a lot of differences between using a foreign exchange brokerage or a domestic one that reports to the IRS. Whether or not your brokerage or exchange reports your income to the IRS, you will be expected to do so. So please don't forget that. Now, what are some of the things that we learned from all this TikTok advice? Taxpayers, the main thing that I would love for you to take away from these videos is that you cannot trust all the tax advice that you see on TikTok or other platforms. It doesn't matter if the videos that you're watching have gotten tons of views or tons of shares. If the advice is not being given by someone who is a tax professional, an enrolled agent, or a CPA, there's a very good chance that the information is wrong. The fact of the matter is that the US tax code is very elaborate and complicated. It takes years of study, takes years of training, and some experience to be able to understand it well enough and confidently enough and accurately enough to give advice about it on social media platforms. So if you make the mistake of trusting advice from a TikTok personality who's not a CPA, there is a big chance that this could cause a serious problem for you. And a worst case scenario could potentially even cause you to be charged with tax fraud or tax evasion. So should definitely not just assume that all of the advice that you see on these social media channels are true or accurate. If you have any tax questions about any of the issues covered in these videos, such as deducting business expenses, being in an S corporation, vehicle purchases, deducting 179, having a secondary home, self-employment deductions, placing your children on payroll, income reporting, then you can get in touch with my team by just clicking on the description and the link below. As a reminder, I am not a licensed CPA. I'm a licensed enrolled agent. I hold the highest designation the IRS allows. I have helped thousands of people leverage the United States tax code in order to reduce their tax bill legally. Additionally, if you would like to learn more about taxes on your own time, feel free to enroll in my courses. I have one in particular course that I'm thrilled about called Tax Alchemy. Tax Alchemy is where I provided a wealth of information about everything you need to know in order to keep your taxes as low as humanly possible legally. You'll learn how to invest in real estate. You'll learn how to get into real estate if you've never gotten into real estate for the first time. I'm going to teach you advanced depreciation strategies to accelerate depreciation, offset your W-2 and your 1099 income without you having to leave your desk. So if that is something that you're interested in, I look forward to seeing you in that training. That is all for today's video. Thank you guys so much. And please be safe out there with any new TikTok videos that you watch. Send them my way. I'll see you on the next one. Cheers.